Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. My guest today is Will Ryan, CEO at GraniteShares. We'll talk about inflation and commodity ETFs, and we'll also touch upon some other interesting topics like dividend ETFs and single stock ETFs. Will, welcome back. Great to have you on the show.
Thanks, Nina. Great to be back on the show. Thank you.
So commodities were very hot earlier this year, and that was thanks mainly to inflation worries, because commodities are seen as inflation, as a hedge against inflation. But investors have become cautious on commodities lately, and in terms of performance too, the Bloomberg commodity index had surged. It was up more than 35% from the beginning of the year through June 9th. And since then, it has been kind of coming down, and commodity ETFs have been losing assets since then. Though I would add that the Bloomberg Commodity Index is still about 18% year to date. So lately, investor worries have shifted from inflation to growth slowdown, and they worry that the demand for commodities may be impacted when the economies around the world slow down. And looking at the recent inflation reports, both CPI and PPI for the month of June, they were very hot, much hotter than expected, and most of those gains were driven by energy, though shelter and food prices were also major contributors. So there's still hopes that inflation might have peaked in June because oil prices, energy prices have fallen significantly in the past few weeks. So I wanted to start with your thoughts on recent inflation reports, and do you think that inflation has peaked?
Let's maybe start with the inflation peaking question, which is, in short, I think it's way too early to say whether inflation has peaked. And I'm sort of almost surprised at the so-called commentators out there that seem to be so sure that inflation has peaked. And the reason for that is, yes, that, on the one hand, there is some evidence of the economy slowing down. We now have two negative quarters of negative GDP. And there is some evidence of commodity prices slowing down, or commodity prices softening on the back of the weakness that we're seeing coming out of China. However, energy prices are still high, still significantly up this year versus where we were at the beginning of the year. The job market's still strong in terms of unemployment numbers. The supply chain issues that we've talked about for the last sort of couple of years are still very much in place. They haven't gone away. The consumer's still spending money at this stage. And so I think it's just too late. And I mean, it's too early, to say that inflation has peaked. And I think the other thing I worry about is some of the commodity price drops that we'll talk about probably in a minute has been because there's been lower demand than anticipated in the summer driving season, particularly for gasoline. And, we're coming into, in not that long a period of time, into the winter season. We know we have deep problems in Europe with regard to energy security for this upcoming winter season. We have drought situations as well here in the United States, as well as in Europe, which is affecting supply chain issues, particularly with key waterways such as the River Rhine going through Germany. And I think that at this point in time, it's just too early to say whether we're going to have an end to the volatility and the commodity price volatility that we've been seeing, particularly on the upper end of the market. So I think that inflation is going to be persistently higher than expected for longer than expected. I've been saying that since the beginning. There may be some signs of inflation dropping in some areas, but I'm not sure that we're at a stage where we can say that we've seen the peak.
Yeah, I agree with you. It's too early to say that inflation has peaked. Now, let's talk a little bit more about some of the key commodities, and oil in particular. Oil had surged to over $120 a barrel in the beginning of June, and now it has come down to around $90 a barrel. And, there have been worries about growth slowdown, particularly demand slowdown in China because of their zero COVID policies. And the OPEC and its allies just agreed to increase oil production slightly. And that comes after a very high profile trip by the president to Saudi Arabia. So tell us about your thoughts on oil. Where do you see oil prices going in the coming months?
Well, the prices have come down, like you said, for the reasons that you've just highlighted. I think another one to throw in there is that I think that there's been a reduction in the risk premium from the Russia-Ukraine crisis. And when we talk about the commodity prices this year and, where we are today, in other words, we're, 18%, higher today than we were at the beginning of the year, as measured by the Bloomberg Commodity Index. And, across the board, any energy commodity you look at is up materially from where we were at the beginning of the year. Now, I think part of that was that, we had an abnormal premium, put into the market when Russia invaded Ukraine back in February. And I think there was a lot of fears, clearly huge fears that conflict could escalate into something much, much worse than what it has. And I think as that conflict has sort of ground on, so to speak, and largely become confined to the eastern part of the country, that risk premium that was inherent at the beginning of the conflict has come out of the market. And indeed, before really we got the news about the second quarter of negative GDP contraction, that we already had a situation where most commodities were trading at the levels that we saw before the Russia-Ukraine crisis, with the exception of obviously a few. So I think that risk premium has come out of the market. The supply chain issues are still there. The underinvestment in the commodity complex is still there. I think the major factors leaning on prices at the moment are fears of recession and persistent high inflation. And of course, those two kind of work in tandem, because the fears of recession means that from a market perspective, markets anticipating lower demand if that turns out to be the case, coupled with obviously higher inflation on the consumer, meaning that the consumer has less discretionary spending to spend on things like gas or energy products, commodity products more broadly, which is impacting demand. I think the other thing, as you mentioned, which is very important, is China and what's happening there. And that's been a double whammy, really, of China's growth slowing down quite significantly, significant issues in the economy with regard to the property market and the situation there, with a lot of credit issues, property developers, plus also the zero COVID policies, which have locked down. And as we know, with commodity prices and particularly with energy prices, that was the thing that killed the oil price in 2020, when we literally shut down the vast majority of the global economies that have shut down demand for oil and drove prices to zero and very briefly below zero. So that's kind of where we are. But as you rightly pointed out, the big thing is OPEC have agreed to increase, OPEC Plus, I should say, increase supply by 100,000 barrels a day starting in September. But that's really a drop in the ocean. That's really not going to do anything in terms of affecting the picture. What by far and away the bigger issue is getting supply back to where it was even pre-COVID, and we're still not there yet. Coupled with the lack of capital expenditure in the space that we've really seen for the last decade, and really the inability for oil companies to dramatically bring more supply online much quicker. And all of that really leads into the situation where I think coming into winter, winter this year when there's much higher demand for energy, but particularly gas in Europe and the games that Russia's playing around the supply of gas to Europe via the Nord Stream 1 pipeline could put us in a situation where we see much higher oil prices, gas prices, but energy prices more broadly towards the end of the year.
So let's talk about food prices now. And food prices have also come down significantly in the past few weeks, which is very good for emerging markets, the developing countries. But before that, the war in Ukraine had sent food prices surging at their fastest pace ever. And we know that Russia and Ukraine, these are two major exporters of grains, and they account for more than a quarter of the global trade in wheat, fifth in corn. Ukraine is also a big exporter of sunflower oil. And very recently, Russia is going to allow exports of Ukrainian wheat, and that is expected to cool wheat prices a little bit. But just after that agreement was signed, Russia attacked two of Ukraine's biggest ports. And that has kind of raised doubts whether Russia is going to adhere to the agreement or not. But talking about food prices in general, they have been coming down. And I saw a recent report by JP Morgan economists that forecasting that global food inflation will fall by about half to around 5.5% or 6% in the fourth quarter of this year from about 13% in the second quarter. So tell us about your thoughts on food inflation.
Well, as you rightly just pointed out, agricultural commodities really across the board are down year to date, with the exception of soybeans, which is probably the one outlier. But I think the good news is that we saw the first shipment of grain coming from Ukraine just in the last few days. And so, hopefully that blockade, so to speak, will begin to be lifted. But, we just don't know, again, how that's going to play out in terms of how much supply will be able to be put onto the market from Ukraine. And indeed, leaving aside that, looking forward to next year, and the planting season, just how much wheat will be able to be planted given all of the disruptions that country faces. So that's still a big unknown. But I think in terms of commodity prices on the agricultural side, it will go back to what it always has been largely, and that is very weather dependent. And, really the crop or the size of the crop, particularly in the United States, will depend on the weather that we have, particularly in these sort of last few weeks, months, or whatever, until we get to harvest. And, right now, the biggest issue is being the drought that we've been seeing, particularly in the Western United States, which is in some cases, worse that they've seen for a long, long time. And if we don't get rain soon in some of the key growing areas, the crops could be severely impacted this year. And so I think again it'll come back to the weather cycle and whether that will be whether that will affect the crops in a positive way or ultimately a negative way this year. But I think certainly in terms of Ukraine and its impact on the agricultural markets, hopefully we can start to get some supply going through there. But again, I should make the point that, agricultural commodity prices are still elevated on a relative basis compared to where they've been the last few years. And so, we're still seeing that pressure in supermarkets, et cetera. And it may be some time before we start to see prices falling at the kind of retail level, at supermarket level.
Right. You rightly pointed out the impact of weather conditions. And even before the war in Ukraine started, droughts in Latin America, they were impacting food prices. And we have seen extremely hot weather in India has also severely impacted crops there. So we will have to keep an eye on weather conditions as well. And that could keep food prices high in the coming months. So I also wanted to talk about gold. because gold is also seen as an inflation hedge. And gold has not really taken off this year. It is down slightly, just a bit year to date. But because stocks and bonds have done much worse, so gold has significantly outperformed other major asset classes. So we can say that it did act as an inflation hedge, but we know that gold usually moves inversely to the US dollar, and US dollar has surged this year, and that has impacted gold prices. And we also know that rising rates dim the appeal of gold because gold yields no income. So tell us about your thoughts on gold, and also tell us about your gold ETF, which is one of the cheapest ways to invest in gold.
Yeah. So first of all, I guess we should say that it sounds obvious, but it's really the key point is that we're talking about the US dollar price of gold, and clearly gold in US dollar terms, has underperformed a little bit this year, and that is because of in main, there are other factors as well, but in the main, the surging US dollar. And as you rightly pointed out, gold typically has an inverse relationship to the US dollar, and so typically does not do that well in times of dollar strength. Contrast that to the gold price in other currencies around the world, so the gold price in British pounds, gold price in euros and Japanese yen, etc. And you'll see highs, if not all-time highs for gold in a number of other currencies because of that factor that the US dollar is so strong. Those other currencies have depreciated against the dollar and therefore depreciated. And the local gold price is a lot higher. I think my take on gold for this year is I'm almost surprised that gold has done so well in relative terms, given the double whammy here of the super strong US dollar. And to put that in context, the dollar is the highest it's been against the euro, for example, the last 20 years. And it's really unprecedented. Plus you have this very hawkish interest rate raising environment, from the Federal Reserve, which has certainly affected markets dramatically. Stock markets down, significantly year to date, obviously caught up a little bit in the last month. But the bond market's down has really pressured a lot of assets on the back of this rate rising environment. And so gold is no exception to that. I mean, typically the two things that gold likes the least are rising interest rates and the strong dollar. So I think given all of that, it's encouraging, if that's the right word, that gold prices have been able to stay at this kind of elevated level. And remember, a gold price around $1,800 an ounce, from a historical perspective, is a high gold price. I mean, this is not an asset that is doing badly in any way, shape, or form. I think the question really on everyone's lips is, if inflation is really high and we know that there are all these geopolitical problems and et cetera in the world, then why isn't gold, $3,000 or $4,000 an ounce? And I think the answer to that lies in what I've just really said about the dollar and interest rates, which is, I think for gold to move up materially higher than it is at the moment, you have to see a reversal in the dollar and or a flattening out or a terminal sort of interest rate pathway, either announced directly, or the market sort of has confidence that there's a plateau to interest rates at some point. I think from there, then providing obviously inflation stays high or stays elevated, I think gold does have a catalyst to move higher. I think another thing that's interesting about this environment is, if we do go into a recession, it may sound counterintuitive, but if we do go into recession, and one of the aspects or one of the unintended consequences perhaps from the interest rate rises and the credit tightening or the tightening of financial conditions is that we start to see a credit crisis on the back of it. In other words, we've seen defaults being almost record lows for several years now, but we start to see a tick up in everything from credit card defaults to auto loan defaults to mortgage defaults, then in that environment, just like we saw back in 2008, we saw gold prices, and then the subsequent 2 or 3 years afterwards, rocket to then an all-time high back in 2011. So I think at the moment, it's positive in my mind that gold's been able to hang in here at these levels, despite all these headwinds. But I think, at some point soon, I think we may be in a position where I think the market's going to more or less decide that the Fed is done raising interest rates, or there's certainly a pathway to seeing what that sort of terminal interest rate might be, and that will certainly soften the dollar, if not make the dollar move in the opposite direction. And I think that will be positive for gold.
Very interesting. And I normally tell our listeners, our readers, that gold does deserve a small place in the portfolio, mainly because of its diversification benefits. And talking about the role of broader commodities in a portfolio, as you mentioned, we discussed earlier that inflation is expected to stay at elevated levels in the coming months, even if it might have peaked and we don't know that. So I wanted you to talk a little bit about the role of commodities in a portfolio, because earlier this year we saw a lot of inflows, a lot of interest in commodity ETFs, and once the commodities prices started coming down, then we have seen a lot of outflows out of these ETFs. So tell us why investors should hold commodities or commodity ETFs in their portfolios.
Well, I think going back to basics, historically, there was really two main reasons why you would own commodities in a portfolio. Number one was a hedge against inflation. And the reason for that was that every single commodity index practically that exists today, comprises of energy, agricultural commodities, in other words, food and energy, plus metals. And typically it's food and energy that are the components that drive inflation, drive a lot of the inflation indexes which governments use. To quote statistics. So by buying the commodities themselves, you're exposing yourself to the commodity prices directly, and therefore if they rise, you profit from that instead of suffer from that. So hedging against inflation, I think most people will be familiar with. The other one, which is perhaps less common these days, although it should be number one in people's minds, particularly now, is diversification. And, a lot of people, I think, had somewhat discounted commodities, perhaps, from that equation over the past 10 years. And certainly the beginning of the 2000s, when we had the last commodity super cycle, I think it was a lot of portfolios that added commodities, and commodities became part of the diversification mix outside of just stocks and bonds. But as the commodity market went into a bear market, after 2011, 2013, people reduced allocations and maybe took out allocations at all as prices came down. And I think, people got a wake-up call again the beginning of this year why diversification is an important thing. And it doesn't necessarily mean that all asset classes will move up, albeit at different levels, that it's okay to have an asset class that is perhaps falling in value, particularly if something like commodities is a smaller part of the portfolio, and therefore the larger part of your portfolio and equities and bonds are moving up in value. But one of the key things that's happened this year, which of course is a surprise, or indeed a very nasty surprise for those holding bonds, after so many good years of being in fixed income as interest rates fell over the last 30 years, has been rapid interest rate rises and expectations of rises, which has really killed a lot of bond investors this year. And bond investors have experienced a negative year, probably for the first time in memory. And so if you're holding a traditional 60-40 portfolio, meaning 60% US equities and 40% bonds, you've lost money year to date. And that's not been a good feeling, given where that portfolio has been for a long time, certainly since the financial crisis. So if you didn't have commodities in the portfolio this year, you've learned a very valuable lesson that diversification matters. And perhaps there are more assets in the portfolio that are valuable other than stocks and bonds. I think that's what a lot of people are starting to realize now, that whether it's gold or whether it's broad commodities, that by diversifying the portfolio outside of just stocks and bonds, you probably have a better chance, all things being equal, in providing some protection against these volatile markets.
Yeah, totally agree with you. Diversification benefits are very important, and particularly in the current market environment when interest rates are rising and bonds are rather risky. Investors need to rethink the traditional 60-40 portfolios and maybe add some commodities, some gold in their portfolios. So you offer a broad commodity ETF. It is the GraniteShares Bloomberg Commodity Broad Strategy ETF. Ticker symbol is COMB, COMB. Tell us about this ETF. I'm looking at the holdings. So it has about 38% exposure to energy commodities, then grains about 22%, and then precious metals, base metals, softs, and livestock. Tell us more about this ETF.
Yeah, so this ETF is really a very low cost way to get exposure to commodities. So it's a portfolio that's comprised of direct commodities, so commodity futures, and it tracks the Bloomberg Commodity Index, and that index is kind of the most famous index, arguably, in the commodity world, or most followed. And as you rightly pointed out, what makes the fund different is that it has a disciplined approach to diversification. In other words, each particular sector in the index can't be more than a third of the index. So you don't get sectors that have a large overweight or large skew like some other commodity indexes. So it rebalances once a year, and at that rebalance, you won't get one particular sector be more than a third of the fund, and no individual commodity can be more than 15% of the index. So it's very well diversified. The expense ratio is 25 basis points. That makes it the lowest cost broad commodity ETF out there, when particularly a lot of the broad commodity competitors are in the 70, 80, 90 basis point range. So it's a very low cost way to get exposure. And the good thing about commodities is that they're very liquid underlying asset class. So although the fund itself is large, people can trade it, go in and out, buy exposure to that without necessarily any fear that the underlying asset class will be illiquid or anything like that.
Very interesting. So commodity ETFs have been very popular this year, particularly earlier this year. Another area which has seen a lot of interest from investors is income ETFs or dividend-paying ETFs, and it's mainly because investors believe that bonds may be risky. So for their income needs, they are looking at dividend-paying stocks and other income-yielding assets. So tell us about your thoughts on popularity of high-income strategies this year. And I was looking at your high-income ETF, the ticker symbol is HIPS, and I found that it has very interesting exposure. It holds closed-end funds, MLPs, business development companies, BDCs. These are areas that most investors do not have exposure to. So tell us about dividend and high-income strategies, their popularity, and your HIPS ETF.
Thank you. Yes. So it's not just that people are nervous about the bond market, and clearly, after inflation, the vast majority of bonds are giving people negative real returns. It's that a lot of the money, remember, of the last few years that people were investing went into growth stocks and went into the growth part of the market. And typically, the trade-off with growth is that you don't get much in the way of a dividend from those companies. A lot of those companies, certainly the very high growth companies, are not even profitable, to not even be able to pay a dividend even if they wanted to. So a lot of people chase growth, and the trade-off was that you prioritized growth in terms of capital growth instead of income. And clearly what tends to happen in when the market goes the other way and you have a slowdown in growth and you have a stock market fall, and certainly you have an environment such as the one that we've been in where interest rates are rising, and interest rate rises particularly punishes high growth companies, that people's mindsets change. And so, it's fine to support growth, but if your portfolio is down, 50% plus because of it, then perhaps your mindset changes to prioritizing income or you're prioritizing preservation of capital instead of accumulation of capital. And so really that's what's happened. And surprise, surprise, a lot of the companies that have high dividends tend to be ones that are more associated with the value sort of sector of the market. So although energy companies have been doing spectacularly well this year, the energy companies typically have fallen into that bucket because the performance has not been great, share price performance over the last decade, but yet those companies are highly cash generative and therefore are able to pay out dividends and in part compensate investors perhaps for the not so great share price performance with dividends. But all that being said, this year, clearly people are really prioritizing income, particularly in an environment where people are not too confident about what's going on in the market, or now worried about the possibility of recession. And so all of that leads to prioritization of cash flows and I think a more defensive stance of the market more broadly. So HIPS, which is our high income ETF, HIPS is the ticker code, by the way, it stands for high income pass-through securities. As you mentioned, Nina, that's a portfolio of pass-through securities, and they're an interesting type of security because they're not a corporation. Otherwise, they're not a common stock. They're not a bond either. And what they are is they're typically partnerships, but they're legal structures that, for tax reasons, have to pass through substantially all of the income that they produce. And they don't pay corporation taxes. So examples of that would be REITs, real estate investment trusts, MLPs or master limited partnerships that typically own energy infrastructure such as oil and gas pipelines. You have closed-end funds, and then you have business development companies. So if you put those together in a fund and then HIPS tracks an underlying index, or the underlying index selects these particular securities, it selects those with the highest yield but the lowest volatility across the four major sectors of the pass-through security universe that we just mentioned, the MLPs, closed ends, business development companies, and REITs. And by blending those together, you get a current, I think, a gross yield at the moment is just over 10% per annum. And that portfolio, while it is more equity-like than it is bond-like, has actually performed well this year relative to the broad market and indeed to fixed income as well. And so what we like to think of with HIPS is it pays a fixed dollar distribution every month. So it pays 10.75 cents, which on an annualized basis, based upon the share price today, means you can lock into a yield whenever you buy it. And that's a really interesting feature of the product. But, getting inflation or above inflation real income in this market has been incredibly challenging. And HIPS is one of the ways to do that.
Yeah, 9%, 10% income yield is really, really interesting. So definitely worth a look. Now, I also wanted to talk about single stock ETFs. And these ETPs have been trading in Europe for several years, but they made their debut, the first set of single stock ETFs made their debut in the US only very recently last month. And I know that you have filed for about 20 single stock ETFs in the US. And I also know that you wouldn't want to comment on those filings before launch. But GraniteShares Europe offers about 75 such ETPs, including 3x leveraged and inverse ETPs on popular stocks like Tesla and AMD. These don't have a lot of assets, about a little more than 100 million in assets, but I was interested in your thoughts and your experience with the single stock ETPs in Europe, and what kind of interest you expect in the US when your funds launch here.
Yeah, so there's been a lot of interest in those products. I mean, obviously, given what happened at the market, and particularly to some of the more growthy names, which are very popular with people, and they make up a lot of our platform in Europe, the likes of Tesla, the likes of NIO, etc. The assets were a lot higher at the end of last year than they are now. That being said, we've certainly seen a bounce back in AUM certainly over the last few weeks, and trading volume remains very high. But I think, the takeaway, and I would say the rationale for doing it is, that there's a class of investor that we're catering to, which is a much more active investor than we've really seen in the past. And, I wouldn't say that it's for all of the portfolio by any means, but there's certainly, I would say, kind of a typical investor that maybe has a longer term part of the portfolio and a shorter term part of the portfolio. And the shorter term part of the portfolio is much more inclined or much more interested in trading and being more active or on the long and the short side, particularly in some of these more popular names. We know that leveraged ETFs more broadly have been a hugely popular category for many, many years. And, leveraged ETFs on broad indices, both in the fixed income world and in the equity world, are very popular. Also, some of the most traded products are actually on the commodity side, but particularly on individual commodities. So think of leveraged products on oil, natural gas, etc. So single stocks, if you think about it, are really just an extension of what's already happened, or an evolution of the market that we've seen really for the last 20 years. And now, just with the advent of better technology, more efficiencies in the market structure, you're able now to deliver leverage against individual companies, both on the short and long side.
Good stuff. That's all we have time for today. Will, thank you so much for joining us and for sharing your insights. Always a pleasure to have you on the show.
Thank you so much. Thank you for having me. It was a pleasure. Look forward to speaking with you again.
So that was Will Ryan of GraniteShares. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.